Hello, dear students. Let us understand about trade credit in this session. Trade credit usually comes under, financial management course under the topic working capital. So there are different concepts like trade credit, commercial paper, promissory notes, all such things. For short duration where we are procuring funds, okay, for running our business. That is the main purpose. So introduction of trade credit. So what is this first? As I said, no, just now I said like it is a short-term financial agreement. Okay. Especially in B2B transactions. See, whenever supplier allows a buyer to purchase goods or services, whatever, and pay at a later date. See here, instant payments is not made. Okay. So between buyer and seller, goods transaction or services, whatever that will happen, but payment on some later date. That is what mentioned here as within 30 to 120 days, short duration. Okay. So it acts as an interest-free working capital mechanism. Okay. The purpose of doing this, see, meaning itself, trade is nothing but goods. Trade means goods. Okay. And credit, you're just selling your goods on credit basis. Okay. Not by immediately getting the cash, instant payment, but you will get the payment later. Okay. The main purpose or main motive of this trade credit, at any point, business, production should not stop. In that case, so, buyer, he needs to buy the goods, okay, and do the production from the supplier. Seller is also in the same position. He needs to sell the goods. Anyhow, he cannot get the payment in an, immediate rate, but later he can get the payment. Okay. So that smooth production will happen because of this trade credit. Okay. So this mechanism, this is what working. So yes, it actually refers to the commercial agreement between, that agreement between the proper, this is the amount of goods that we purchased, amount, all the particulars will be mentioned. This so and so date, the whatever amount mentioned. Say for example, 1 lakh means 1 lakh will be, you know, returned to the seller. Okay, this is what the simple agreement. And types of trade credit has different types. The first one is open account, and next is trade acceptance, and third one is promissory note. So what is this open account? See, goods are shipped without a formal agreement. Here, you may not, see any formal agreement over here, and the payment is expected within agreed, just on his trust and the relationship history, past relationship, and the buyer already. Okay, on that basis, you can able to, ship the goods. Okay, just simply on because of his trust. Okay, that is what open account. Trade acceptance, like here formal agreement is signed before delivery, before delivering the goods. Okay, whatever raw materials or any components, seller is willing to sell his goods. At that case, before delivering that goods, a proper agreement is made. Okay, and that is what the trade accepts. And next is what promissory note is, like a legally binding document, okay, where the buyer commits to paying a specific amount on a defined date. Defined date, imagine that after 90 days, so I'll make you the payment. So this is made as a proper legal binding document, so that buyer cannot skip from his roles and responsibilities. Okay, so these are all the three types. And how this trade credit works. First one is buyer seller or supplier agreement. Okay, so agreement means like it all the things will be mentioned, like goods, regarding the goods or services. Okay, price and the terms and conditions. Okay, and second is invoice issuance. So where here supplier sends invoice to the buyer. Invoice, like what is the what are all the products, how much quantity, all certain things with the proper specific amount will be mentioned in that invoice. And third is payment terms. How we are going to make the payment. So specifies when payment is due. So after 30 days, after 60 days or 90 days, whatever. Okay. And credit period is buyer has set time to pay without penalties. Yes. And last is payment settlement. So buyer will definitely makes this payment on the so and so agreed date. So advantages, it's very simple. It's not a complicated process. And next is cash flow. It happens between buyer and seller, and then working capital operations. Here it is very simple process. Okay, so long-term relationship or partnerships, it happens here. And then operating costs is what very lower, and then business growth, competitive edge. See, as I said, there are many advantages. At any point, your production is not going to stop over here. So anyhow, you are going to build a smooth relationship between buyer and supplier. Okay. So disadvantages is also here, like it's time consuming at sometimes. Okay. Rare cases, and then late payments may occur. Okay. And then credit worthiness, if that is fails, getting the payment from the buyer, sometimes it feels some difficult thing. And next is over dependence on trade credits, that is also sometimes a danger part for you. And then some suppliers may not provide this trade credit because of many their managerial reasons. Okay, so they are based on their roles and responsibilities, or may their policies, they may not agree to this trade credit concept. Okay, so this is all about trade credit. Thank you.